quantitative tools of monetary policy, that is OMO, that is reserve ratios, third interest rates, or you can say liquidity adjustment facility. As I said, OMO and reserve ratios were prevalent from since independence, while LAF came into being in 2000. And nowadays, LAF is the most prominent tool for controlling liquidity in the economy. And in LAF, the repo rate is the most critical. And if we talk about UPSC perspective, UPSC many a times they are direct. It has been observed there are direct questions in the examination in pre. And apart from that, UPSC ask analytical questions by relating these concepts with the liquidity, with the inflation part. If inflation is changing or if there is huge liquidity, then how you can control through OMOs, through reserve ratios, and how you through the liquidity adjustment facility. So this is how you have to tackle the questions. Another concept we will try to understand is sterilization. Sterilization means disinfection. It's in medical terms, sterilization is disinfecting. What is disinfection in the economy? Disinfection in the economy means if in a global scenario, because we are integrated globally, so in that scenario, there can be either huge inflow, there can be huge inflow of foreign currency, let it be dollar. There is huge inflow of dollar, or there can be huge outflow of dollar. There can be any of the situation. Now imagine a situation of inflow of dollar. When there is huge inflow of dollar, then what will happen in the economy? There will be excess of dollar. There will be excess of dollar. And when there is excess of dollar, it will result into appreciation of rupee. Appreciation of rupee. That we will how it takes place. We will discuss it in the exchange rate. To understand now, when there is more dollar, then relatively amount of rupee will be less in the economy. When amount of rupee will be less, that means the importance, the significance of rupee will increase. That is said to be appreciation of rupee. Now to avoid this situation, or to regulate, to control this situation, because appreciation of rupee is not good for exports. It is not good for exports. Now what RBI will do, the solution before RBI is to remove this excess of dollar. To remove excess of dollar, to remove, removal. Removal of dollar. This removal of dollar means, again, if RBI is removing dollar from the economy, what it will be putting in the economy? Then RBI will put rupee in the economy. RBI will be putting rupee in the economy. That means rupee will be increasing in the economy. Rupee will increase in the economy. That means liquidity in the economy will increase. It will result into so the situation will be rupee will increase in the economy. It will lead to inflation in the economy. Then what is the way out? The way out before RBI is to remove this removal of rupee. How it can be removed? By open market operation. That means rupee is to be removed. So in lieu of rupee, RBI will inject government security. That means sale of government security. So this is one example of how RBI will tackle the process, the inflow of excess dollars. So the process in which, if you analyze this situation, so it was inflow of dollar. It was followed by RBI purchase of dollar. It results into increase of rupee in economy or inflation. And the solution was to remove this money, that is sale of government security. This whole process from this inflow of dollar to managing the situation till the sale of government security is said to be the sterlisation. This sterlisation is important to understand a situation of market stabilization scheme. Market stabilization scheme. In 2004 times, when economy was growing, there was a huge inflow of dollar. It was a time of India shining. There was huge inflow of dollar and it was resulting into appreciation of rupee. At that time, India or the government, this inflow of dollar was so huge that government was also not in need of the money, right? Then sterlisation took place, but this sterlisation was a bit different. Why it was a different? Because in every sale and purchase of a government securities, for example, if RBI is selling government security, that means it is pulling rupee, or it is said to be it is borrowing the rupee, borrowing rupee. Now in 2004, what was happening, that there was huge inflow of dollar. RBI was supposed to remove this money, but the government said that we are not in need of money, because borrowing means it is resulting into fiscal deficit of the government. Because when the government is borrowing the money, that means it is increasing the fiscal deficit of the government. But the government was not willing for that. Now, what was the option? What was the solution? The RBI came up with a solution and stated that we will sell government security, which will result into removal of rupee from the economy. But government, this money will be kept aside in a separate account, and it will be not used by the government. No use by government. Then what about the interest? Government stated that yes, we will pay the interest, but this interest will not be part of fiscal deficit. It will not be part of fiscal deficit. Why? Because we are not using this money. We are not in need of this money. You keep this money aside, we will pay the interest, but it will not be part of our fiscal deficit. It will not increase our fiscal deficit. And it is said to be the carrying cost of marginal standing facility. It will put a burden on the government, but will not increase the fiscal deficit of the government. And the objective of MSF is only to maintain the monetary stability in the economy. This was how the monetary stable marginal standing facility works. So this was all about the quantitative monetary tools for the economy. And if we analyze the monetary policy throughout the years, we have to understand that during the time of at the time of independence, monetary policy, the objective of the monetary policy was to maintain the exchange rate with sterling parity. When we got independence, we adopted 5-year plan, and the objective of monetary policy was to provide credit availability, and the tools were open market operation and reserve ratios. In 1969, nationalization of banks started, and this nationalization of bank, the objective was financial inclusion. And again, the tools were open market operation and reserve ratio, and to ensure the credit availability. In 1980s, what happened? That government increased the supply of money into the economy through the fiscal policy. Sukma Chakravarti committee took note of it, and in 1985, the committee recommended for changes in the monetary policy objectives, and it stated that the RBI should ensure that there should be control of inflation, there should be no fiscal dominance, and yes, credit availability should be there, taking growth into mind. In 1998 onwards, the monetary policy took the approach of multi-indicator approach. Multi-indicator means now the monetary policy was supposed to take into account inflation, it was to take note of exchange rate, it has to regulate growth, it has to also regulate call money market, and so on. The maintenance, the regulation, or having a balance between these three, inflation, exchange rate, and growth, it's a very tedious process, and that's why it is also said to be trilemma of RBI. And in 2016, as I discussed, that in 2015 there was an understanding or signature sign of monetary policy framework between government and Reserve Bank of India. And 2016 onwards, we are having inflation targeting regime. And initially, it was for the 5 years until from August 2016 to March 2021, and it has been extended up to March 2026. So, as of now, we are in the regime of inflation targeting regime, in which the Reserve Bank of India is supposed to maintain consumer price index in the range of 2 to 6%. Thank you very much. That's all.